Ever wondered how investors figure out how profitable a company is? The answer lies in a key financial metric called earnings per share, or EPS. Let's break it down and make it super simple. EPS shows how much profit a company makes for each share of its stock. Think of a company's earnings as a pizza. EPS tells you how big a slice each shareholder gets. To calculate earnings, per share, or EPS, you take the company's net income, subtract any preferred dividends, and then divide the result by the average number of common shares outstanding during the period. Net income is the total profit the company earns after all expenses. Preferred dividends are payments to preferred shareholders, which don't count for common shareholders. And average outstanding shares are the total shares owned by the public. There are two types of EPS. 1. Basic EPS. This is the straightforward calculation using the current number of shares. 2. Diluted EPS. This factors in potential shares, like stock options or convertible bonds, giving a more cautious estimate of earnings per share. So why does EPS matter? It's a clear way to measure profitability. The higher the EPS, the more profit the company is making per share. Investors use EPS to compare companies. Think of it as a report card for how efficiently a business generates earnings. EPS is also used to calculate the price-to-earnings, PE ratio, which helps investors decide if a stock is overvalued or undervalued. Here's an example. A company earns $1 million in net income, pays $50,000 in preferred dividends, and has 500,000 outstanding shares. Plugging it into the formula. The company earns $1 million in net income. First, subtract the $50,000 in preferred dividends from the net income. This leaves $950,000 available for common shareholders. Next, divide this $950,000 by the 500,000 outstanding shares. So $950,000 divided by 500,000 equals $1.90. The earnings per share, or EPS, is $1.90. That's EPS in a nutshell. It's a simple yet powerful way to measure a company's profitability and make smarter investment decisions. Now you're one step closer to mastering finance.